The view, though, is that if you look at the basis of the law, what they were looking at is the SMEs. Most of the SMEs, by their very nature, some of them are sole proprietorships, others are SACCOs like you're mentioning, and those are registered under their relevant domain laws and not necessarily under the Companies Act. I would think that what the legislature is trying to do is cover those, and they'd be considered as registered businesses.
So all those taxes have to be paid, but now you have to add a 2.5% of infrastructure levy and import declaration fee.
So we're going to see slight, I don't think it will be slight. Most times people abuse the increments. So we're going to see increments in prices. And I think what we need to do is just brace ourselves for that, because I think unless it's the parliament is courteous enough to drop that bill, but if they don't, then we're going to see an increase in prices.
I would encourage everyone out there who thinks that they're affected by these bills to participate actively in these committee discussions. Why? We have had instances in the past where the committee discussions have actually resulted in some amendments happening to the bills. So this is not final.
Hello, good afternoon, everyone. Welcome to the Tax Hub podcast, a special edition of the Tax Hub podcast. Special in the sense that we get to discuss a very timely and topical issue. The biggest engagement in the tax space currently are the tax amendment bills. So it was imperative of us to have a special edition just to break down and make sense of these tax amendment bills. And every year around March or April, we get to see the tax amendment cycle commence, and it always commences with the Minister of Finance presenting the bills for gazetting. And about a week ago, on the 25th day of March 2025, we saw the Minister gazette a total of 7 tax-related amendment bills. So we just deemed it fit to have a discussion and engagement with profound tax consultants to make sense and to break down these amendments, what they mean for you a taxpayer, you a business person, you a Ugandan, so that we can all appreciate the same. And joining me on this special edition of the Tax Hub podcast is a very formidable panel comprised of very experienced tax consultants. And in no particular order, to my immediate right is Mr. Bruce Musinguzi. You're very welcome to the Tax Hub podcast.
Thank you very much. Bruce Musinguzi is my name. I'm a partner with Kampala Associated Advocates. I mainly concentrate in the tax practice, and I'm glad to be here.
Thank you very much, Bruce, for making the time to engage our dear viewers on such short notice. We're very honored to have you. To Bruce's immediate right is a gentleman, John J. Tusabe. John J., you're very welcome to the Tax Hub podcast.
Thank you, Edwin, for inviting me. I'm very happy to share this discussion with very experienced colleagues in the profession. My name is John J. Tusabe. I'm a Director of Tax at BDO.
Thank you very much, John J. We're honored to have you as well. And lastly is a lady. She comes in from an audit firm as well. So the other panelist is Jemima Irene Naziri. Jemima, you're very welcome to the Tax Hub podcast.
Thank you. Good afternoon, everyone. I'm happy and honored to be here, first of all, as the only lady on the team. And I'm happy to exchange ideas, and I think this is going to be a great discussion.
Thank you very much, Irene. Ladies and gentlemen, Edwin Mike Chiba is my name. I work with BDO East Africa, and I'm honored to be your moderator this afternoon. So just to kick us off, we saw the Minister Gazette, a total of 7 tax amendment bills that included the Income Tax Amendment Bill of 2025, the VAT Amendment Bill of 2025, the Tax Procedure Code Amendment Bill of 2025. We saw the Excise Duty, but we also saw other tax statutes, including the External Trade Act. We also saw the Stamp Duty. And in there, the quite pertinent proposals that we need to just take a deep dive and have a deliberate engagement on the same. So we just want to kick in with the Income Tax Amendment Bill. This is always one of those topical bills in every tax amendment cycle. And for this year, we get to see very welcome proposals. The feeling is these are quite welcome in the tax space, but we just have experts in here to just guide us through and have us partake of this discussion. And I just want to bring in John Jett. John Jett, you're kicking us off. the Income Tax Amendment Bill number 2 of 2025. It's something that has gotten very many people talking. Would you just want to walk us through what are some of those highlights of this amendment bill? What are some of those key provisions that our taxpayers out there should take keen note of?
Thank you, Edri. On income tax, the government has tried to minimize introduction of new taxes under income tax or increasing the tax rates under income tax, which is good. So credit to our tax policymakers. Now, what stands out for me from a number of tax proposals in the income tax amendment bill, one is the drive to support small businesses by extending an income tax exemption for 3 years. That is a good idea because a number of our small businesses struggle with taxes, and from the various studies carried out, taxes are one of the contributors of the low life expectancy of small businesses or startups. So this particular proposal, which seeks to introduce an income tax exemption for 3 years, is a welcome move. However, the way it is designed creates a lot of challenges or potential challenges at implementation when URA is now implementing it. Because it says that if you are a new business, you are established after 1st July 2025, and your registered investment capital is not more than 500 million shillings, then you would qualify for an income tax exemption for 3 years. Of course, there are anti-abuse provisions like if your associates or relatives, you cannot benefit from the same exemption more than once. And there's also a requirement to ensure that you file your tax returns. Now, the intention of this provision is wonderful, but its design of saying it applies to businesses established after 1st July 2025 is problematic, because if you're trying to make sure that businesses, startups continue by giving them an exemption, then are you saying that those that started before 1st July 2025 and they have a high mortality rate, as you have acknowledged, should we let them die because they don't qualify? So there's need to tweak the design of that proposal to ensure that small businesses that genuinely qualify are extended with that relief. Similarly, the law does not guide on what constitutes investment capital or investment capital for it to be registered to qualify. With that ambiguity, it will create implementation challenges between taxpayers and URA, and at the end of the day, you might find that the intention of extending relief to these small businesses might not be realized. So there's need to clarify or define what constitutes investment capital and for how long. If I invest not more than 500 million in over the 3-year period, do I qualify, or does it have to be in the first year? At what point do you start counting? 2, if my business at URSB has a registration of 1st July 2025, this amendment is saying you won't qualify because it applies to businesses established after 1st July. So those kinds of issues need to be resolved so that qualifying businesses that are intended to be facilitated are not disadvantaged. Then the condition of filing returns and information returns is also not clear, because we've seen that one of the challenges of small businesses or presumptive taxpayers is preparing financial statements, which is very costly. Hiring the likes of German Nazari in this market is pricey, comes at a premium. So meaning that if you put a condition that is going to chase away the qualifying business, then there's need to design so that is simplified. If there's a return that information that needs to be provided, it shouldn't be the general information that is filed by established businesses that have accountants, have finance departments to prepare those pieces of information. So those I would say are my key observations around the need to exempt small businesses. The intention is good, but the design needs to be looked at so that the purpose is not affected by ambiguities when it comes to hitting the road. Then the other amendment that stands out for me is when it comes to reorganizations, if you are a company, a group of companies, and you're transferring assets, ordinarily that attracts capital gains tax if there's a gain established. But the provision which deals with rollover relief or deeming the transfer of assets not to be a disposal that triggers capital gains tax is there to ensure that when businesses reorganize or restructure to achieve business efficiency or to be more competitive or achieve their strategic objectives without a change in the underlying ownership, such a transaction should not suffer capital gains tax. So the challenge has been that it was mainly referring to a company transferring assets to another company. However, real life experience is that one of the shareholders might have assets in their own names and they want to reorganize, have all their assets under one company or two, and they want to transfer them to this company. Under existing law, one could make a case that the exemption or the rollover relief wouldn't qualify, and you end up taxing such a person when they have not made any money in the transaction. So the amendment which provides that removes that hurdle to provide that you're interested in a person transferring assets to another person without reference from company to company. It makes it possible that as an individual shareholder, when you move your individual assets to the company as part of your restructuring, you won't pay capital gains tax. And I think that's a welcome move, except that there are a few drafting aspects in the language of the proposal that need to be corrected so that when one reads it, there's clarity, and to avoid issues of dispute with URA, there are some aspects of the wording to make sure that it achieves its intended purpose. So Edwin, I would say those are my key highlights of income tax. Thanks.
Thank you very much, Jed. Jed has set the ball rolling and he has given a very good perspective to it. But just before bringing Jemima, Bruce, Jed made mention of something very pertinent. The exemption is tied to registered businesses. But one of the questions has been, what is a registered business? Is it one registered with USB? If I can register with my circle, what is registration? So could you just clarify to our dear viewers or audience what kind of registration is envisaged, or what should the taxpayers take of this?
Yeah, thank you very much, Edwin. I think I agree with Jed's statement. One of the challenges that you have with the law as it stands, the proposed law, is that it doesn't define many of those key terms. For instance, what is a registered business? Lawyers in our practice, we know that we are registered with Uganda Law Society and Uganda Law Council. We're not registered with other entities. Does that qualify me to be a registered business? In my practice, yes. But can somebody in URA actually say that, no, a registered business is an incorporated entity? So if I have a partnership and it's not incorporated, or I have a company that is not incorporated, I don't fall under that category. The view, though, is that if you look at the basis of the law, what they were looking at is the SMEs. Most of the SMEs, by their very nature, some of them are sole proprietorships, others are circles like you're mentioning, and those are registered under their relevant domain laws and not necessarily under the Companies Act. I would think that what the legislature is trying to do is cover those and they'd be considered as registered businesses.
Thank you very much, Bruce, for shedding light on that. So I want to bring in Jemima. Jemima, what are some of your highlights in this income tax amendment bill? Jade has given us his perspective. Bruce has shed more light. From your reading of the income tax amendment bill, any notable proposals for you?
I think the proposal on section 86, that's a digital services tax that was introduced, where they've come to exclude transactions that are happening between associates, because before the digital services just covered everyone. So now they've come to exclude them, and the law has given guidance that these actually now fall where you're dealing with, you have digital services, but with an associate, then these are covered with other sections of the law, like section 82. So we go and read those sections as opposed to the section on digital services. So that is one of the clarities that has been made, and I think it's going to help. I know one of the things that it could have been looking at is there was a rate where they were saying digital services would be 5%. And so if you're dealing with related parties, then people could take advantage. But if you're looking at other sections, then we are looking at 15%. So maybe they would want to iron that and say, if I am dealing with an associate, then we are dealing at different terms than where I'm dealing with an individual.
Thank you very much, Jemima. And I think Jemima, Jet, and Bruce are doing an amazing role of breaking it down. We hope you, our dear viewers, at least can appreciate a thing or two about the income tax amendment bill. But ladies and gentlemen, just want to skip into the next fundamental bill. The tax procedure code is a very fundamental law in tax practice, matters tax. So I just want to bring in Bruce. Bruce, this is always one of those amendments that we look forward to as a practice. Do you mind just breaking it down for us? What are some of the highlights this time around? What should the taxpayers take in note of?
Okay, thank you, Edwin. I think there are just three aspects of the bill. I'll try and address them briefly. I'll start with a more interesting one, which is the extension of the non-payment of interest and penalty for purposes of income tax or for all the other taxes that have been clarified under the tax procedure code. So what has been happening since COVID, you'll recall that from the time of COVID, they used to grant us an exemption. It started in 2020 when we had the COVID exemptions, which were basically waiving interest and penalty, provided you are ready to pay the principal tax. That was then extended a couple of times. What we now see in the TPC is that we are now being given an extension further for if you pay your principal tax between 2025 and 2026, then you're going to be able to have your interest and penalties waived. The joy of that is that what has been crippling businesses more or less in this country is that I'll have a principal tax of, let's say, 1 billion. And then you want to charge me an interest of 800 million. It means at the end of the day, I'm going to pay 1.8 billion. Many taxpayers would rather not pay that. I think for me, this is fundamentally important, especially for us tax practitioners, because that encourages taxpayers to be compliant. The other thing about it is for them to create the pro rata-based form of claiming that waiver. The pro rata-based form of claiming the waiver means that, for instance, if I had a principal tax of 1 billion and I'm not able to pay the entire 1 billion, but I'm able to pay, let's say, 50% of that, does that mean I'm not entitled to the waiver from interest and penalty? That has now been answered in the tax procedure code. And what they are saying is that, yes, you'll have the waiver, but it will be on a pro rata basis. In other words, you'll only get 50% off. Now, the more interesting one is, like Jet said at the beginning and Jemima, is that now you're bringing in persons into the tax fold. What has been happening previously is that all of us had to have a tax identification number. Now they are saying, no, we shall use your identification number with NIRA. In addition to that, we can also use your identification number with URSB. What that does for us practically, to the viewers out there, it means that, for instance, Bruce and Edwin, who have been doing business but have not been using their tax identification number, URA is now able to capture us. In addition to that, what the law is also saying is that even when you're doing any business locally, your local authorities will refuse to license you if you don't have that identification number. What that does, Edwin, practically, it means that if I go out there to apply for a trading license today, ordinarily, my local authority might not ask me for the tax identification number. However, now they'll ask me for my NIN. If I don't have a NIN, then they'll not be able to give me a license. What that means is that from where URA stands is that they're able to know all of the transactions that you and I have conducted using our NINs. In other words, what I see the taxman doing now is that they are widening the tax base.
All right, maybe if I can bring in Jet. Jet, just to pick up from where Bruce left, around the NINs. So we've seen some questions. What's up? What will be happening to foreigners who don't have NINs? Maybe I don't have a business registered with USB. So could you just clarify more on the tax identification number pertaining the foreigners? What will the foreigners be looking out for? Is there anything they'll be using?
So for foreigners, they'll be using the tax identification of their home country, provided that that home country where they're coming from has a double taxation agreement with Uganda or has an exchange of information program or agreement with the government of Uganda. And you'll find that with the upcoming implementation of the automatic exchange of information, URA is going to be connected to many countries' systems on exchange of information. So chances are that in most of the countries where these companies or individuals come from, they'll be captured. But if someone is not registered in their home country, in other words, they haven't been complying, which is going to be rare, given how each country is trying to drive its revenue collection, you'd still have to apply to register for taxes. So the requirement to apply and register for taxes has not gone away. It is still there.
Thank you very much, Jet. So what Jet and Bruce are saying is the taxman is coming for you. If you've been running, you can no longer hype. They're certainly coming for you. And to bring in Jemima, one sector that we've seen hit a little hard with the taxes, the gaming sector. And I think this time around, we're seeing an amendment that seeks to consolidate and have a centralized payment gateway system. Would you just shed more light into what's the context behind this whole thing? What should players in that sector look out for?
Thank you, Edwin. So basically, before we've had the betting companies that were operating online, I think those URA was able to have visibility into their transactions. They would know who have you paid, who money that you've received. But then now these local, the ones you find in our home states, those ones were not registered. So URA did not have visibility. So it was easy for someone to just go and bet and get their payment and go away. What this law is saying that any sports betting company cannot pay you money or receive money from you unless they use the centralized system. And what this means that for you to use the centralized system, you have to have a NIN. So you can no longer just get your money and go and bet. And they're going to have visibility into everyone. So, and URA is going to look at this information. If over the year you have betted 100 million, of course they're going to come and ask you, we've seen you've made these bets, but we've never seen you paying income taxes. So what are your sources of income? Where have you been getting this money? So everyone, like Bruce said in the beginning, the tax base has been widened and everyone is now in the net. So they'll have more visibility, and I'm hoping that if the taxes are used well, then at least it will lighten the burden on the few who have been paying taxes.
Thank you very much, Jemima. Jed, I just still want to bring you in. Every time someone looks at the Tax Procedure Code Act, penalties is always of big concern. And I think there's been an issue around IFRS compliance. We're seeing an amendment around IFRS non-compliance. Would you just shed more clarity? Is IFRS failing? What's the issue around IFRS? And what's amendment seeking to import around IFRS?
So IFRS is not failing. IFRS is succeeding in spite of the challenges, and like any system, there'll be challenges, but I think with the working together of taxpayers and URA, the system is being made to work. Now, when you look at the previous penalties, they would charge you a lump sum for non-compliance and like 6 million. If you say a bottle of water of 1,000 shillings, you haven't issued an IFRIS, then you pay 6 million shillings as a penalty. That penalty is not connected to reality in any way. So what they are trying to do now is to harmonize the penalty regime for IFRIS such that the penalties you pay are also linked to the taxes that are not being complied with in respect of the transactions involved. So the adjustment being proposed, in my view, is welcome because it links, it makes the penalty as a percentage of what you have not declared through IFRIS.
Thank you very much, Jet. Ladies and gentlemen, the discussion around the Tax Procedure Code Act is quite exhaustive and we can't take it all in here. So I just want to skip to the next amendment bill. Bruce, I want to bring you in. Stamp duty is another very contentious thing out there. And I think on our previous episode at the Tax Hub podcast, we had a deep dive on stamp duty, and the issue was that public notice on agreements. We also, it came with a lot of queries, a lot of challenges, it was distorting everything. And I think this time around we're seeing the lawmaker coming in to try to take a nip on that. So Bruce, would you just walk us through some of the highlights of the Stamp Duty Amendment Bill? And in your view, what are some of the challenges seeking to address? How can you make it better?
Okay, thank you. One of the challenges that we had with the Stamp Act as then is that it provided for a liability for any agreement or MOU. Now, the challenge with that is that it was so broad. It's so broad in a sense that if you and I entered into an agreement today, we would then have to go and pay stamp duty on that, which I think was about 15,000 shillings. The problem with that is that you have entities that do thousands of agreements. Now, the question is whether all of those agreements are subject to tax. The other challenge with it is the definition of the word agreement was left hanging. So what is an agreement? For instance, if today you go and subscribe for DSTV and they give you that offer letter and you sign on it, is that an agreement? And should you pay stamp duty on that? Now, the flip side of it is that it made it impossible for the taxman to also collect the tax of stamp duty. Why? An agreement between you and I, Edwin, is not an agreement that we shall expose to everyone until we disagree. Therefore, the taxman would never have wind on it. And therefore, in terms of collection, it was almost impossible for the taxman to make collection on that tax. I think, given the cries that have come out from the public, especially the Uganda Law Society, that this tax was starting to hinder business, I think the drafts people have taken heed of that and decided that now let's propose an amendment to remove that tax or stamp duty on agreements. Proposing there to be nil, I think, is very good because, like I've said, for practical purposes, Edwin, when you and I disagree, then we shall go to court. When we go to court, you and I, one of us has to raise an objection that this agreement is not valid, cannot be relied upon in evidence because I didn't pay stamp duty. What the court normally does in those instances is to tell me to go and do what? And pay the stamp duty. So at the end of the day, if you and I don't disagree, if we don't raise the objection, the taxman will never collect that tax. I think for me, if you ask me, I think it's a very welcome proposal in terms of it's impractical to collect this tax. And number two, it just hinders business. So I think for me, if there's any highlight in the Stamps Act, the bill recommending to remove that tax is very welcome.
Thank you very much, Bruce. And to bring in Jemima. Jemima, is it the same feeling? Are you one of those proposing that, let's have these stamp duty on agreements repealed? Or just to borrow from experience, as an audit firm, you get advice various clients on compliance. Just to pick on experience, what has been the experience around stamp duty on agreements? What are clients saying? Where is the issue? And what are some of your highlights around the stamp duty amendment bill?
I think just like Bruce has said, removal of stamp duty on agreement is a very welcome proposal. I think last year when URA started issuing the letters to different companies to account for stamp duty on agreements, it caused a lot of discomfort within, because first of all, URA had never enforced this. And then out of the blue, they are coming and they're telling people to go back as far as 2018. So imagine in 2024, they're telling you to retrieve all the agreements you've signed. So it is a welcome proposal, because also companies sign a lot of agreements. So if you're going to pay stamp duty on each and everything, the cost of running business was actually becoming very high for these companies. So it is a welcome amendment. And also even, yes, from our tax clients that we had, that is one of the things that they felt like was unfair for URA to enforce, because they were saying, if I do not have a disagreement with the whatever agreement that I've signed, then why do I have to pay taxes on it? Or if I had employees that left in 2019, why are you telling me to pay stamp duty now? So that's a very welcome proposal. And I think the other one that we've seen is also putting a nil stamp duty on mortgage deeds. And I think this is also in line, because most times you see that if they had removed stamp duty on our bank loans, and then most of the people take these mortgages for bank loans, then it was just imperative that we also have the mortgage deed have no stamp duty.
Thank you very much, Jemima. And ladies and gentlemen, on episode 3 of the Tax Hub podcast, we had a deep dive on stamp duty. And one of the notable issues was stamp duty on agreements. We had a very formidable panel that took a very elaborate discussion. So in the event you still have any concerns around stamp duty, episode 3 would be a very good one to watch. I just want to bring in Jet. Jet, you advise quite a number of business associations, business leaders, business people. And this year we saw an amendment to the External Trade Act. And this amendment seeks to have a nip on very many importers, exporters. Would you want to just break down for our dear viewers what are some of the key highlights around the External Trade Amendment Bill, and how is it going to impact business out there?
Thank you, Edwin. For businesses that rely a lot on imported goods, this is very important to take note of. As you know, Uganda is a net importer. In other words, we import more than we export. So what the External Trade Amendment Bill is saying, one, let's have at the point of importation of goods, let's have an infrastructure levy of 1.5% and an import declaration fee of 1%. So in total, it is an additional charge on the cost of taxes you pay. So 2.5% on top of what you have been paying. You've been paying import duty, which can range, say, 10%, 25% or plus, depending on what you've brought in. You've been paying VAT at 18%, unless the item is exempted. You've been paying withholding tax. So all those taxes have to be paid, but now you have to add a 2.5% of infrastructure levy and import declaration fee. Now, infrastructure levy is said to be intended to add to the financing of our infrastructure. As many of you know, you are not happy with your infrastructure, especially roads. So where is the money going to come from? So government is saying contribute 1.5% and an import declaration fee of 1% so that government can get financing to do these things. However, not every good at importation will be subject to these two levies, which sum to 2.5%. If you are importing something that is exempted under the 5th schedule of the East African Customs Management Act, you will not pay. So meaning that you need to check, what am I bringing? Is it part of the exempt schedule? Or is it plant and machinery? So plant and machinery is being exempted because you import plant and machinery not for consumption, but you're going to use it for value addition for production. So such things are being exempted. Or you're importing goods that are under or covered by the special operating framework with the government of Uganda. That is normally issued by the Ministry of Finance. So if you're importing goods in that category, then you won't pay the 2.5%. But I will tell you that majority of the goods don't fall within that exemption or exception. So be prepared to pay more charges whenever you import goods. And even if you are not an importer, but you are a consumer of goods, you either buy them from the supermarket, you buy that shoe, that shirt, that dress that is imported. When the seller is telling you the prices have gone up, please understand, maybe if the increase is 40%, like, no, the increase was 2.5%. But when you look at how taxes are calculated, you might find that VAT might apply on some of these charges. So the overall cost to the business person could be more than 2.5% in terms of increase. So expect prices of consumable goods to go up. Then the other aspect that is being introduced is imposing an export levy on at the point of exporting wheat bran, maize bran, or cotton cake. Normally, these are items that agricultural items that are used as inputs in production. So they are introducing an export levy of 10 United States dollars per ton. Normally, every country wants to encourage exports. So this is one of the few exceptions where a levy or a tax is being charged on exports, because exports bring in foreign currency. So that's why you don't tax them. But this time round, they are being taxed for one main reason. This wheat bran, maize bran, or cotton cake, many of our industries, like that make feeds especially, they use these as inputs in the production process. So if the agricultural sector is not producing enough of these items to form inputs into the production in the manufacturing process, and there is a higher demand by people from outside Uganda for these items, then when the guys from outside, say coming from Kenya, are paying higher price for maize bran or cotton cake, you'll find that farmers will be selling to those guys. And our manufacturers here won't be able to have the inputs they need to produce safe feeds. So this tax is intended to minimize or discourage the export of these critical inputs in the production process. So I would say it's a welcome move as part of the efforts to enhance local production and value addition.
Thank you, Jet. That there was very extensive and elaborate. I hope people don't mistake you for having been one of the people advising the Minister of Finance on that particular amendment, but thank you very much, Jet. That was quite extensive. Jemima.
Sorry, I just want to clarify. I was involved in the discussions with the Uganda Manufacturing Association. So the pains that they have, they took them to the ministry, and the ministry has positively responded.
Oh, thank you very much, Jet, for that clarity. I think the Taxa podcast brings you such profound experts who are guiding the associations, who are guiding the ministry, as well as guiding the taxpayers. So thank you very much, Jet, for voicing the concerns of the taxpayers. And we hope to see at least the trade sector being bettered. And to bring in Jemima. Jemima, Jet just confirms that you as a consumer, you as a trader, things are getting worse. Yeah, on top of the taxes, 2.5% is coming to impact everything we're importing. Just want you to shed more light on you advise and you engage various importers, traders. Would you just give us a picture of after 1st July 2025, what's it going to look out like? How is it going to affect that consumer, those ends, that customer walking to a shop, that man in Chikubo there? How is this amendment going to affect them?
Thank you, Edwin. Of course, the impact, like Dred said, it's going to be in increased prices. Of course, the sad part is we know what happens in Uganda. There is a 1% increase in taxes, and then the people selling say 40% increase in taxes. So we're going to see slight, I don't think it will be slight. Most times people abuse the increments. So we're going to see increments in prices. And I think what we need to do is just brace ourselves for that, because I think unless it's the parliament is courteous enough to drop that bill, but if they don't, then we're going to see an increase in prices, and that's going to be for both goods and, of course, automatically, if anything, if goods are going to increase, then even people in services somehow will also try to increase the prices. So it's something that we need to look out for, and also try to see, of course, and I know that the drive where government is coming from is, we know that the cash constraints, there's been a reduction in the donor funding. Of course, that means that now the burden is shifted to us. We have to raise that money to build the roads, to put in hospitals. So that is one of the initiatives that government is doing to get more money because donor funding has been reduced. So that is something we will just have to look out for, and we pray that maybe the discussions with the manufacturers and traders, that the increment is not so exorbitant that it actually hurts the final consumer.
Thank you very much, Jemima. I just want to bring in Bruce. Bruce, another law that we see impacting every single taxpayer of the ends is the excise duty. And this time around, are we seeing the usual players? Are we seeing a replication of the previous amendments? Bruce, would you just want to highlight for us what are some of the notable aspects we should take keen note of in the Excise Duty Amendment Bill of 2025?
Okay, one of the notable aspects is the introduction of remission of tax, where you have a destruction or expiry or decay of your produce. Anyone who has gotten goods from a manufacturer in Uganda will know that most goods are sold ex-factory. And because they're sold ex-factory, you end up also paying the VAT and excise duty as you're taking out those goods. But Edwin, one of the situations you need to look at is that imagine you take out those goods and as you're getting out of the factory, you get an accident and all of your goods are damaged. What happens? Previously, you'd want to go back to the URA and say, look here, I paid this tax, but these goods were destroyed, they were damaged, I need to get back a refund. And URA would say no. Why? Because they would be telling you, I don't have it in the law. What the government is now doing is to introduce that into the law. So for a person who is purchasing goods locally, they would now have the benefit of, if there's the goods expired, they got destroyed, or they got decayed, they can now go back to the URA and claim a remission of their tax. The only challenge with the law is that it gives with one hand and takes away with one hand, is that it doesn't really allow you to now claim back the cash value of that money, but it's allowing you to use that against your other taxes. The problem with that is that knowing how URA works is you will always have an audit after that. So when I apply for a remission, URA is going to say, okay, fine, give me proof these goods were destroyed. When I give proof those goods were destroyed, if you think the value is too high, then they're going to say, I need to audit you. What I would have expected the law to say is that if my goods are destroyed and I prove it, maybe within 1 to 2 months, I should get a refund. And if I want to have an offset, then I should be allowed to have an offset. We don't see that coming out in the law, and it's going to create a lot of confusion like we've always seen with the other tax heads. The other aspect, maybe in excise duty, that always happens is the increase in fuel prices. I can see now it's increasing by 100 shillings. We notice that every time, I think, which is a smart way, government make sure that all of us feel the pinch of taxes. So they increase fuel by 100 shillings. So we will be seeing that coming in. Where we seem to be getting some relaxation this time is that the telecoms haven't been affected like they usually are affected. which was a positive. So those are some of the highlights I could see. Yeah.
Thank you very much, Bruce. And I think the excise duty as well as the external trade amendment bill, those are bills that are going to follow very candidly to see what's taking center play at the Finance Committee of Parliament, what's taking center play on the floor of Parliament, so that we just track these amendments and see what's the final amendment, what has been passed, and how does it impact child ends. The other bill that affects a few sectors or a few taxpayers is a VAT amendment bill. So I want to bring in Jemima. Jemima, this is also one of those routine acts that come in to change a few sectors, a few businesses from zero rating to standard rating, a few to exemption. So would you just highlight for us, what are some of the key highlights around the VAT amendment bill this time around?
Okay, I think the first key highlight is on, I think before we've had the government initiative of trying to ban or reduce importation of mivumba, used secondhand clothes. And I think one of the things when government tried that initiative or trying to pursue that initiative, the question was, what are the alternatives that you have? Because I think maybe in the days of our parents, we had the night tills working, and Uganda had the textile industry, which we did not have. So government, in an effort to uplift the textile industry, and also I think going with the future ban of secondhand clothes, then they are putting an exemption that for textile industry that they are going to exempt the supplies. And this is going to, if this goes well, then we expect that we're going to have more people coming into Uganda to actually manufacture clothes, and then that will reduce on our consumption of secondhand clothes. Of course, maybe the big question is going to be, like most people say, do we trust Bubu? Do you trust that the clothes that are going to be manufactured in Uganda will be up to standard for what people are willing to wear? Or will people say, I'm willing to pay a little bit more extra in the import, like we talked about, because I want to have good quality clothing? So if actually the investors do a good job and that goes well, then it would be a good thing, because yes, in some of the secondhand clothes, we've seen that there are certain undergarments that ideally a person should not be able to, but because of circumstances, people end up buying that. So I think that's a very good welcome. The other one was on importers, persons who import goods in more than one consignment, but when aggregated, that person should have been registered for taxes. Then these are falling under the threshold. And like Bruce said and Jet, we're going back to widening the tax base. So before, we've had the importers where you just keep importing small things and selling in your business, and then you're not caught within the ambit of VAT registration. But now they'll be able to monitor and say, oh, you brought in this shipment, and basically you could have brought them in all at once. So if you can do that, then they'll say you are a taxable person, and therefore VAT is going to be imposed. The other amendment that we've seen, solar lanterns have also been included under the exempt supplies. So people who are providing solar lanterns and the raw materials into the input of solar, then those are also going to be zero rated and exempt. And then for zero rating, they've included the supply of aircraft. So those have been the key amendments in the VAT.
Thank you very much, Jemima, for helping us take track of which one falls where, and that was very good to just take record. But I want to bring in Bruce. Bruce, there's that tax consultant, that taxpayer dozens who's watching these bills, who's reading these bills. Would you just walk us through what next after these bills? Could you just walk us through the tax amendment cycle from the time the bills are gazetted until when URA starts enforcing them? Because people following the debate, what should they just take regard? Now that we see the bills out, what's happening next, what will follow through, so that we just keep track of these bills out there.
Okay, so when the cycle as it stands is after the Minister of Finance issues its bills, then the bills are taken to Parliament. When they are presented to the Committee of Parliament, it gives an opportunity to the public to come in and give their views regarding the bills. I would encourage everyone out there who thinks that they are affected by these bills to participate actively in these committee discussions. Why? we have had instances in the past where the committee discussions have actually resulted in some amendments happening to the bills. So this is not final. Not all hope is lost. You still have a chance at the committee stage. When they're done with the committee hearings, the Committee of Parliament then presents the bills to the August House. The August House then debates the bills again. Again, you have another opportunity at that point using your MPs to go to the MPs and talk to them about the particular provisions in the bills that you think affect you. We have also had instances where at the August House, some bills have been amended. They have sent them back to Ministry of Finance to change. So there's always an opportunity. Once Parliament passes the bills, they are then taken to the President for assent. And once the President assents to these bills, they are then gazetted. And at that point, they become law. That's the cycle. Yeah.
Thank you very much, Bruce, for breaking down that cycle. And to bring in Jet. Jet, I think over time we've seen you appear before this Finance Committee of Parliament to voice concerns of different taxpayers. And just want to bring in and pick from experience what you've represented most of these organizations. What has been experience like, and what would you be telling taxpayers out there now that the bills have been sent to the committee?
Thank you, Edwin. Two things. One, the committee normally wants to know what is it that you're happy with. So you have to make it clear. What is it that you don't like in the proposal, and how do you propose it to look like? So, like some of the aspects, we see there are some good proposals that have come through. Those ones we should welcome them as the business community. And those that have issues that need to be addressed, then we need to bring them out as well. But of course, there are other pains that the business community that has had for a long time, but they have not been addressed in these amendments. So the question is, can some of those also be considered at the committee stage as well?
Thank you very much, Jet. And I just want to pick it from your very last point. There's some pains in the taxpayer industry that have not been considered in this amendment cycle. So I'll start with, that's something all of you, I'll post all of you. I'll start with Jemima. Jemima, you advise taxpayers on a daily, the voice their concerns. So in 1, 2, 3, what are some of those pinpoints? What are some of those notable challenges taxpayers are saying, and you expected to see them in these amendments, but they're not in there? Anyone in a 2, any 3?
Thank you, Edwin. I think one of them is on capital gains, where especially where non-residents are concerned. That yes, there was a law that was put in place, but there's still some ambiguities. And in the recent past, we've seen so many cases where URA has had a different interpretation from what the interpretation that taxpayers are reading. So we expected to see more of that, because we know that one of the initiatives is we are encouraging investors to come into Uganda. But then what happens when this person has invested and maybe at a certain time they want to sell? Because if we are making it harder or being very stringent with our tax laws, then we are going to discourage investors. So I would have expected, since many taxpayers have raised a concern on capital gains disposals for non-residents, I would have expected to see some amendments or clarifications in that.
Thank you, Jemima. We hope the lawmakers are listening. We hope the committee members are listening. Jet, you advise taxpayers on a daily. You represent taxpayers on a daily. What are some of their concerns that you felt were missed out in this amendment cycle?
Quite a number, but I will say 2. One being, like anyone listening, our income tax rates for individuals are quite high, if not the highest in our region. And that is not good for a country that is striving towards developing a middle class. If you're charging a high tax as high as 40% on a small base of 10 million shillings, then the question is, are you trying to encourage savings? Are you trying to encourage working hard? Are you trying to encourage innovation? It's in the negative. So I was expecting to see our income tax rates or pay as you earn rates being adjusted, because when you look at the last time these rates were adjusted, the threshold of 235 in 2012, 235 of today is worth much less in dollar terms. So 10 million shillings for the 40% to apply of 2012, 10 million shillings today is worth much, much less. So meaning that if we maintain these high tax rates, they affect so many people, and you're not even, yes, revenue collection is much easier, but you're affecting so many parts of the economy in terms of savings, in terms of innovation, in terms of working hard to produce more, in terms of retaining talent in the country, because a lot of good people are also leaving the country because partly there are big opportunities out, but the take home here is also quite low because of the high taxes. So I was expecting to see a change in that direction, but in the circumstances, I would understand that it is very hard. It's a hard paper on the policymakers' side, given the revenue challenges. Then the other I was expecting is the problem of interest capping under Section 25 of the Income Tax Act, where it is being applied to even local groups of companies that have no connection to the external world in terms of profit repatriation. All the profits are taxed here, they remain here, they are reinvested here. So why are you applying this this provision that was intended to mitigate profit repatriation by multinationals? Why are you extending it to local group of companies that are not even borrowing from related parties? They are borrowing from local banks or from multilateral lenders. So that for me is a challenge that I'm struggling to understand why the government is not addressing it at this point. Otherwise, if we're saying we want value addition, we want investment, but then you're holding the leg or the guy who is trying to run in that direction, what are you doing? Thank you.
Thank you, Jet. Those are very good insights, and we do hope that lawmakers are indeed listening. Bruce, just like Jet, just like Jemima, you advise taxpayers and even non-taxpayers on a daily. What are some of those challenges they're having, and you hope to have seen, but there's nothing be replicated in these laws?
Okay, I think I'll just address two of them. One of them is conclusion of audits. Now, the biggest challenge that you see with taxpayers is URA commences an audit, let's say in 2017, and they continue with that audit cycle until 2023 and give you an assessment in 2024. Just imagine that period, Edwin, that for 6 years you've been going through an audit, and every time they're asking you for documentation, you're sending them documentation. The other challenge that you have with URA is that the Bruce that you started with for the audit is no longer there. So now you have Jet has come in, Jet leaves, Jemima comes in, she leaves. Then all of a sudden Edwin comes in who says, oh, I do not agree with anything that my colleagues was doing, so we are now going to start this afresh. So he spent 6 years going through the same documentation. No company has that time. So I thought what would happen is that the Ministry of Finance would have a clause there that actually provides that once you commence an audit, can you please conclude it within at most 12 months? One of the other things that we all suffer with is claiming refunds. Every time you put in an application for refund, URA comes with an audit. What that basically does is that it discourages the local person out there. Why? If I supply you goods and you're entitled to your input and you claim your input and URA comes and decides to audit you, would you want us to continue having a business where I'm giving you an invoice? No. So what I expected the lawmakers to say is that if I'm entitled to my refund, I should get it. But I don't see it in the bill. Those are my two major concerns. Yeah.
Thank you very much, ladies and gentlemen. These are very pertinent points, and that's what the Tax Hub podcast seeks to address. Some of these gray areas, some of the areas we believe deserve amendment, and these amazing proposals, these wonderful insights are something we're going to document and shall be working along with KAA, BDO, KPMG to see to it that, we can suggest and improve our tax landscape. I just want to bring in Bruce. Bruce, the Uganda Law Society is a very fundamental organ in these tax policy engagements, and you a very formidable member in the revenue and tax cluster of Uganda Law Society. What are we seeing this time around? Is there anything that the Uganda Law Society is seeking to do? Yeah, I think among its associations, your role, even at the finance committee level, is very, very pertinent. So is there anything the ULS tax and revenue cluster should be cooking? Is there anything should be expected?
Yeah, there's something that we are cooking as the cluster. We are going to prepare a paper, like I had mentioned in the process of getting this bill into becoming law. There are committee hearings. So as the cluster, what we are preparing is a paper that we want to present to the committee. One, to express some of our concerns on the bills, but two, to also express some of the concerns on the things that haven't been included. Especially when you look at some of the bills, like we mentioned earlier, some of the issues are there's ambiguity. Some terms have not been defined. If they are not defined, what that means is that you give legroom to URA to keep on disturbing the taxpayer. Of course, when there's ambiguity, all of us know it should be determined in favor of the taxman. Unfortunately for us, is that URA looks at it in the reverse. So as a cluster, what we're trying to do is put a paper together that we can share with the Committee of Parliament.
Thank you very much, Bruce. And we look forward to the Uganda Law Society paper on these tax amendment bills. Kudos to you and the entire committee. Jet, what should we expect from BDO? I think over time, we've also seen you make appearance before the committee. What should we expect? Are we seeing BDO this time around? Are you supporting Uganda manufacturers, PFC? Are we seeing you this time around getting involved?
Yes, as BDO, we are also going to share our thoughts on the proposals, but also get the input of the business community because they understand the business more than we do. So we'll get their views and also engage through the various associations, Uganda Manufacturers Association, Private Sector Foundation, and together we have one voice around the issues and the pains that we would like to be addressed.
Thank you very much, Jet, and we also look forward to your engagements at a committee level. Jemima, we've seen KPMG also over time come in and support different association sectors and taxpayers and make very formidable proposals before the committee. Is that something the viewers out there should expect this time around?
Yes, as KPMG, we're always committed, first of all, to ensuring that we help taxpayers just to dissect the tax amendment bills. And one of the things we will be issuing an alert just for the general public to dissect this tax. What exactly in the layman's language, what do the bills mean for us? We will continue to support the different organizations to have those amendments, and also we're never called upon by Ministry of Finance to always sit in those committees to just give what is our understanding, our interpretation, and what have we heard from our clients are the pain points. So we shall continue to do that.
Thank you very much, Jemima. To our dear viewers out those ends, the consultants are putting pen and paper to see that the bills are modified and bettered. So we encourage you as taxpayers, you as a Ugandan, the committee is very welcoming. Codify your proposals, put down your proposals, put down your sentiments so that you can present them before the committee. And you see to it that our tax laws are better, tax laws are improved, so that we can have a very formidable and a level playing field in the tax terrain. So ladies and gentlemen, just before we wrap it up, I just want to pose one question to each of you. We've seen very amazing proposals across the different bills. So I'll start with Jemima. Jemima, just one of all these proposals, what has been your best proposal in this amendment cycle and why? Just one across board and why?
I think for the extension for the exemption period for taxpayers to pay principal tax and have a waiver. I think why it's a welcome proposal. We've had it previously, but normally the period given would be short, so 6 months. So sometimes it's not possible for someone to clean house and make payment. But the fact that they've extended it for a full year, then that means that taxpayers have been given a chance to go back, do their self-reviews, evaluate, and then pay these taxes, which is going to be very beneficial both to the taxpayer but also to URA, because we'll be able to also iron out hopefully the lacuna of the ledger reconciliations in this 1 year period.
Thank you very much, Jemima. John Jett, what's your standout and why?
What stands out for me is the stamp duty exemption on agreements. It stands out for me because it had created a lot of chaos as to what constitutes an agreement. Literally, even a verbal agreement was subject to stamp duty if you take the legal meaning of a contract. So for me, I'm happy that government has listened and they're removing the stamp duty on agreements. Thank you.
Thank you, Jett. Bruce, what's your one and why?
I think for me, my one is the remission for excise duty purposes. The reason for that is that I know so many people who have been victims to either destruction of the goods, decay of the goods, or expiry of the goods. And one of the challenges that we always had with the URA is when you'd apply for the remission, they'd say there's no provision in the law. So them creating a provision that allows remission for me is a highlight. Yeah.
Thank you very much, Bruce. Ladies and gentlemen, the special episode of the Tax Hub podcast will be coming to a close, and it's been a very extensive, comprehensive, and insightful discussion by industry experts and leading tax consultants. And we just want to express our gratitude, firstly, to Mr. Bruce Musinguzi. Bruce, we're very honored to have you. You've made the time to come and share your knowledge with the taxpayers out there. That's very kind of you. Very grateful to you, Bruce Musinguzi. Yeah, Bruce comes from KAA, one of the leading firms that we're working very closely to see to it that we better the tax practice and landscape. Thank you very much to Bruce and the broader team at KAA. Secondly, John Jett. John Jett, we're equally very honored to you. You made the time off your busy schedule to come in and just take the time, break it down for the taxpayers. That's very, very commendable of you. So to John Jett, to Sabe, and the broader BDO team, we're equally very grateful for having you on the Tax Hub podcast. And we look forward to deeper engagements with you and the broader BDO team at the Tax Hub podcast. To the only lady on the panel, Alice, yeah, you've given very, very candid, very practical, and very insightful talking points and recommendations, as well as advice to our dear taxpayers out there. So Jemima and the broader team at KPMG, we're equally very grateful for having you on the Tax Hub podcast, and we look forward to deeper engagements with both you and the broader team at KPMG. So, ladies and gentlemen, that was a special edition of the Tax Hub podcast. It centered the discussion around the bills. We deemed it fit to just have a discussion when the bills are still very fresh, but the debate doesn't stop here. We're tracking the bills, we're tracking the next processes, and certainly at a later stage in time, once the bills have been passed, we shall equally have another episode just to ascertain what is the final amendment, so that we can also have a discussion around that particular amendment. Because over time, we've seen the very first proposals get dropped along the way, they get improved. So we shall have a deeper discussion just to ascertain those final bills that have been passed, those that are going to become law, and certainly have a deeper discussion on how they'll impact you. So from the Tax Hub team and to all our dear viewers, we're very grateful. Do not forget to hit the notification button and like our YouTube channel, where we get to bring such practical, insightful, and simplified discussions. We look forward to seeing you. Episode 4 is in the offing, and we look forward to having another meaningful debate. Thank you. Have a good afternoon.